The housing market is in a recession and a bottom in the stock market has yet to be seen. I have all the details and what analysts are now saying about current market conditions right here in the video, so let's get right into it. Alright, now as you can probably tell, we have a lot to talk about right here in the video as information continues to change very rapidly and we are watching these markets unravel right before our very eyes, so let's get into it and discuss all the details. However, really fast before we do, if you have not claimed your $34 worth of free stock, make sure to check out that link down below at the top of the comment section. I will pin a comment with a link there. Otherwise, down below in the description, there will also be a link there if you're interested in checking it out. However, if you use that link to sign up and deposit at least 1 penny, you're going to get a guaranteed $34 worth of free stock, possibly hundreds or even thousands of dollars worth of free stock simply by using that link and again, depositing at least 1 penny. Now, when I signed up doing this, I got just under $100 worth of free stock, including 1 share of Starbucks that was a little bit over $80 just for that 1 share alone. So super cool. This is a limited time offer. I wanted to bring it to you right here just in case you're interested. It is not required, but just if you're interested, feel free to check out that link down below, again in the description and at the top of the comment section. All right, now let's get into it and talk about the housing market first, because as of recently, they've actually been determining this market as being in a recession, and the stock market, oh yeah, that has not even hit definitive lows as of yet, even though recently we've been seeing some nice moves higher in the stock market. According to what analysts and experts are now saying, the bottom is far from being put in this market. So let's talk about this because we're watching these two markets unravel literally right now, and this is going to cause a lot more pain going forward ahead, which has also been indicated by the chairman of the Federal Reserve, Jerome Powell, just a couple weeks ago, as he was also out indicating that the Federal Reserve will continue raising interest rates very aggressively going forward, and he also indicated that this is going to cause pain for businesses and households. In other words, making it way more expensive to borrow money, and we're going to see that pain going forward. So again, these are the words out of analysts and experts, the chairman of the Federal Reserve, Jerome Powell, as well as a variety of other highly authoritative people. So with that being said, let's talk through the details about the housing market first. All right, so like I said, recently, they've actually determined the housing market as falling into a recession. Now, here's what's going on with the housing market. It's actually kind of interesting to see the turnaround on this thing because over the last couple of years here, literally since mid-2020 out until just a few months ago, we've been seeing the housing market literally on a tear. This thing has been going up very, very fast, and prices have been appreciating very fast in real estate. In fact, we've been seeing price appreciation about 30% the last couple years. That is way above the norm. In fact, real estate typically appreciates between about 3 and 6% a year, 6% being even a very aggressive year. So as you can see, these years, last year, 2020 and 2021, with prices appreciating at the rates that they have, it's simply not sustainable. Well, as a result of that, the Federal Reserve has been coming in, raising interest rates very aggressively over the last few meetings, and we're likely going to continue to see interest rates raising even more aggressively with their upcoming meetings. Now, with the Federal Reserve raising interest rates, it does not directly translate into the price of mortgages, as in the interest rates on mortgages, but it is all highly correlated. As a result of that, as the Federal Reserve continues to raise the federal funds rate, in other words, the interest rates when banks lend to each other, the overnight lending rate is what the federal funds rate is, that's also going to translate into higher interest rates on literally everything else, including credit cards, auto loans, student loans, personal loans, lines of credit, home equity lines of credit, literally mortgages, you name it. Any kind of debt that you might be getting into or that you might have that has an adjustable rate, of course, it is going to be impacted by this. Or if you're looking to open up any new types of debt instruments, it's all going to be higher interest rates today than what it was a year ago, year and a half, even 2 years ago when interest rates were pretty much zero, right? For example, at the beginning of this year, interest rates on a 30-year fixed rate mortgage were below 3%. As of recently, interest rates on a 30-year fixed rate mortgage are almost 6%. They've doubled just in the last, say, 8 to 9 months or so. So that is massive, right? Interest rates on a 30-year fixed rate mortgage have virtually doubled just in about 8 months' time. That is almost unprecedented interest rate hike. So As a result of that, many buyers in the real estate market have been kind of stepping away from the market because when it comes down to it, these higher interest rates are impacting the payments for buyers in a very significant way. We're not talking about a little 0.25% interest rate hike. We're not talking about 0.5%. We're talking about 3.5%. We're talking about 3% interest or even 4% interest rates more than what we were seeing just 8 months ago. So these are very substantial increases in interest rates. And as a result of that, the cost to borrow money as a result of a mortgage is just getting more and more expensive. So many buyers are simply stepping away from this market. Now, as a result of that, we're also seeing many different economists and many analysts out there that are watching the real estate market very closely, and they're suggesting that in some markets around the country, we could see contractions of about 20% to the real estate market. Now, again, I watch real estate very closely, just like I do the stock market, the bond market, I watch crypto, I watch all kinds of things very closely because I know that all these markets are highly correlated. If any one of these goes down, it's going to take the rest of it down with it. So I like to watch all these markets very closely. Now, here's the thing. In some markets around the country, yes, we easily could see contractions of 20%, maybe even more, 20%, 30%. However, in other markets around the country, we're not going to see contractions of 20%. We might see 5, maybe 10, maybe 12 or 15% in some markets around the country, but it totally depends on where you're looking around the country. Some markets around the country, because here's what's interesting about the real estate market. All across the country is totally different. The real estate market in New York is very different than the real estate market in Boise, Idaho. I don't know. I'm probably saying that wrong. I know they say Boise. Anyway, if you're located there, I apologize. I'm probably saying it wrong. But my point is, the real estate market in, say, San Francisco is very different than what it is in Austin, Texas. The real estate market in Austin, Texas is very different than what it is in Des Moines, Iowa. The real estate market in Des Moines, Iowa is very different than what it is in Miami, Florida, right? Very, very different markets. So we're talking about the same thing, but we're also comparing, apples to oranges, because realistically, the market is very different all across the country, even though we're talking about literally the exact same thing, right? The real estate market. So in some of these markets, we're likely going to see contractions greater than other markets around the country. They may actually hold up a little bit better. But here's what it comes down to. We've been seeing a lot of different information out there coming across saying, we're going to see a massive crash in the real estate market. Now, here's the thing. Totally depends on where we're talking about around the country, but realistically, based on everything that I'm seeing, I do not anticipate a major crash. The reason for that is there's way too much demand for housing. There's a lack of supply and there's a lot of demand. Well, if you know anything about supply and demand, simple economics, that is not going to cause a crash. There's just no simple way that can happen. When demand is high, supply is low, there's no possible way that a crash can happen. It doesn't happen that way. Now, the other way around, if demand was very low and supply was very high, then we'd be looking at a massive crash. That's where we would see a crash coming from. But we're not seeing that situation right now. We're still seeing a ton of demand out there. Meanwhile, even though those buyers are maybe stepping away from the market right now, if prices do come down, say 5, 10, 15% like that, a lot of these buyers are going to say, hey, I'm stepping back in. The prices have come down. This is a great deal now. I'm happy to buy at this price. And now the payments have also come down a little bit as well. Even with higher interest rates near 6%, even if prices come down, say, $20,000, $40,000, $50,000. Now that same buyer, the payments are going to be less simply because even with a 6% handle on interest rates, payments are going to be less because now the purchase price is even less, right? Does that all kind of make sense? So it's all based on the interest rate as far as how much is going to be for that loan, and the size of the loan is also very important as well. So when it comes down to real estate, yes, we might see a contraction in different areas around the country, maybe 10, 15, 20, maybe 30% in some selective areas. But for the most part, I do not see a massive real estate crash anytime soon. But again, we'll have to continue watching this situation to see what actually happens here. But I want to throw one more quick side note out there. A recent analyst note from somebody out of Goldman Sachs. And again, Goldman Sachs, a massive bank over in New York. A lot of very, very smart people working there. But an analyst out of Goldman Sachs was suggesting that in the third quarter of 2023, we're likely going to see real estate stall out to 0% growth. In other words, the appreciation on real estate is going to stall out so much by Q3 of 2023. So basically a year from right now is going to be zero. that's kind of a stalling out, right? Now, again, that does not indicate a huge crash. It just simply says real estate has stopped appreciating. That's basically all they're saying with that, right? So anyway, real estate's a very slow moving market. But again, we'll have to continue watching, because what happened in 2007, 2008? What caused the massive crash then? Yeah, it was real estate. That's what took everything down back then. So we'll have to watch this one again very closely. Now let's take a minute here and talk about the stock market, because we're also seeing some additional information coming out of some analysts with Goldman Sachs that are also suggesting a decisive bottom in the stock market has not been reached yet. We've also seen other notes out like this from other big banks, including like Morgan Stanley, JP Morgan. We've seen a variety of different notes coming out from different analysts from many of these big banks over in New York on the East Coast, suggesting the bottom in this market has not been put in yet, and we're likely going to see the bottoms from June exceeded relatively soon. So even though we've been seeing some pretty nice moves higher in the stock market recently, again, like we've been talking about here on the channel for a few months now, this is likely a bear trap. In other words, what they do is in the starting phases of a bear market, what happens is the market plunges, and then all of a sudden we see a massive bear market rally. The market goes up really, really nicely, and it looks like, oh wow, this is the start of a new bull market. Well, ultimately it just turns into a bear market trap, or a bear trap, where simply it just brings a bunch of new buyers into the market, where meanwhile the institutions, the hedge funds, the big banks, things like this are unloading their shares to those unsuspecting buyers, and ultimately they rip the market the opposite direction and it collapses once again, causing the next major leg down, and the next major leg down is usually a pretty big one. So again, we'll have to see what happens here, but according to these big banks and analysts as well, they're also suggesting the bottom in this market is not in yet, and those lows that were put in June are likely going to be exceeded and broken, and likely the S&P is likely going to bottom somewhere around the 3,000 to 3,400 range, which is down quite a bit from where we're currently sitting right now at about 3,900. So anyway, some interesting notes here right now. I want to bring these to you to let you know what's going on with the real estate market as well as the stock market. Again, I'm watching all of this stuff very closely because I do know all of this is very highly correlated. Any crash in any of these markets will take down virtually everything else, and it will impact all of us in some way, shape, or form. And just like I said earlier in this video, the chairman of the Federal Reserve, Jerome Powell, has already indicated that their policies and what they're currently doing right now by aggressively raising interest rates is going to cause pain for businesses and households, and they're going to stick to their plan. Therefore, we need to prepare for the pain coming ahead, just like indicated by the chairman of the Federal Reserve, Jerome Powell. So please be aware of all this stuff. I know that it seems like, oh no, we're fine, the market's doing just fine, but again, things change very rapidly, and when things start to hit the floor, things happen fast. Anyway, as indicated by the chairman of the Federal Reserve, Jerome Powell, he also said a lack of action on this, in other words, not doing anything about this inflation now, is actually going to cause even more longer-term pain. So it's better to get it over with now than to continue on with this high inflation. Just like taking the Band-Aid off, right? You know, it kind of hurts to rip it off fast, but it's a lot easier to get it done fast than it is to sit there and pick away slowly at the little Band-Aid, right? We've all been there, done that. Just rip it off, get it over with, and just be done, and then we can move on with our lives rather than sitting there and picking at it really slowly. That ultimately hurts the most, right? Anyway, kind of the same analogy here. So when it comes down to it, I'm watching all this very closely. Again, make sure to grab your $34 worth of free stock by checking out that link down below at the top of the comment section or in the description down below. Simply use that link to sign up and deposit at least 1 penny. Once you deposit your 1 penny, you'll get at least 2 stocks valued between $3 and $300. You'll get those for sure. And then once your 1 penny has gone in and you've deposited that, you'll get a minimum of 4 more stocks valued between $7 and up to $3,000 each. So again, some pretty big money here on the line. So make sure to do that if you're interested in doing so. If not, that's totally fine too. Totally optional. Just want to throw it out there just in case you have wanted to check that out. And again, it's a limited time offer that's still available to you. Anyway, thanks again for watching this. Please make sure to subscribe down below if you haven't done so yet. Share the video with your friends, family, social media, and go back and check out any of the other thousands and thousands of videos here on the channel. Until next time, enjoy your day, and I'll catch you again later in the next video.